Hi, everyone, and thank you for joining our webinar today. My name is Afrona, and I'm pleased to be here with Matthew, our Head of Rig Market Research, and Sophia, Senior Analyst and Valuation Expert. Recently, my team and I hosted a private breakfast briefing in Amsterdam during the IADC World Drilling Conference. We presented the short-term outlook for the offshore drilling market and how IEA and OPEC's oil demand scenarios may affect the long term. We were joined by 40 industry professionals, and today we will be covering much of the same presentation for those who couldn't attend. Please feel free to ask any questions or share your thoughts throughout the session in the Q&A chat box. We will address them toward the end. Additionally, the recording link for all attendees will be available in the following day. The data presented today is sourced from the Esgian Rig Analytics platform, research and analysis. We hope you find the information valuable and insightful. Matthew, you can take it.
Thank you very much, Afrona, and thank you everybody for joining us for our presentation today, Offshore Drilling, Balancing Short-Term Shifts and Energy Security. My name is Matthew Donovan. I'm Head of Rig Market Research at Esgian, and I'm joined today by Sofia Forestieri, our Senior Analyst and Valuation Expert. And moving on with our presentation today, first we'll go to our disclaimer. And then our agenda for today, we'll start with short-term volatility and the current downturn as we take a look at the market and the short-term outlook. And then I will pass the presentation over to Sophia for the long last dance continues, our case for long-term demand in the offshore drilling industry. As a reminder, you can ask questions via the Q&A section of the meeting. Starting with short-term volatility and the current rig market. We're tracking the recent downturn in offshore rig activity. Historical global offshore rig demand for this recently decline began in early to mid-2024. From around 496 units drilling and working in April of 2024, we saw a decline to as low as 456 units in March 2025. Since then, that has settled at around 460 units in recent months, and we've seen competitive utilization trending below 80%. Taking a look first at the jackup market, where much of this decline has come from. We've seen strong headwinds in the jackup market, with rig suspensions in the Middle East having had global effects on the market. Global jackup demand trended upwards from 2021 to early 2024 on increased demand in the Middle East, which absorbed much of the excess capacity in other regions. However, from 371 units in April 2024, the number of rigs drilling under contract in the Middle East fell to 334 units in March 2025, more recently settling at around 345 units. Much of this decline came after Saudi Aramco began placing units on suspension in 2024. We see 31 units on suspension placed throughout the year, and while the company has recently begun awarding new long-term contracts, many suspended units have not been recalled to work and contract terminations have begun. The global market, particularly West Africa and Southeast Asia, has absorbed some, but not all, of the additional availability of jackups from the Middle East. And we have seen uncertainty in the market from these suspensions beginning in 2024, along with the potential impact from commodity price fluctuations and other economic concerns in 2025 that have pushed some demand into the future, as well as supply chain issues which have affected the start of a number of drilling projects. In addition, Mexican state oil company Pemex began suspensions in the fourth quarter of 2024 related to payment issues. We have seen some of these units return to work, while others remain furloughed with an uncertain time frame for securing new work offshore Mexico. And if you look at the chart on your right, you'll see the contracted rig count. That includes jackups with Saudi Aramco or Pemex that have had their contracts suspended but not officially terminated. Moving now to the floating rig market, where we have seen demand deferral, and 2025 levels remain below the peaks achieved in mid-2024. The number of floating rigs drilling and under contract dipped from 131 units in August 2024 to as low as 119 units in November 2024. We've since seen global demand for floating rigs, both drillships and semi-submersibles, stabilize at around 122 to 123 units in recent months. Now, we've seen floating rig demand in 2025 hampered by projects being delayed and expected drilling campaigns being moved into the future. These factors include supply chain issues delaying the start of projects, extended negotiations, and regulatory issues. Operators have also been maintaining strong levels of capital discipline and deferring the start date on projects or holding back on FIDs in order to maintain this discipline. While the spectre of tariffs and declining oil prices has introduced more uncertainty into the market, several long-term contracts for floating rigs have recently been fixed, though start dates are beyond 2025. And so far, we have seen the market observing demand deferral rather than demand destruction for future floating rig demand. Looking ahead to 2026, we're looking at that as a potential inflection point after a lackluster 25, with work firming up for 2026. Global rig demand is expected to decline slightly into late 2025 as rigs currently working finish their contracts. Most recently fixed contracts and work under discussion is trending towards activity in the second half of 2026 and 2027. So we will see a significant number of floating rigs and jackups that are currently available may remain idle until next year. Based on firm demand and contracts in advanced stages of negotiation, total demand is forecast to rise from around 459 units in December 2025 to around 500 units in 2027. However, the possibility remains for some demand to be shifted further ahead, particularly if oil prices decline significantly with planned OPEC output increases. And while announced tariffs from the US have not yet had a significant effect on rig activity, any economic slowdown related to trade could cause a slowdown in offshore rig demand. And added to that now, we have additional uncertainty because of recent hostilities between Iran, Israel, and the United States, which could affect the market via oil price fluctuations or disruptions to infrastructure. Looking forward for the global jackup market, we do see some uncertainty continuing into 2026, with global jackup demand expected to trend downwards in the second half of 2025 as rigs roll off contracts and units remain on suspension in Saudi Arabia and Mexico. We could see a brief upturn in activity towards the end of 2025 based on programs under discussion, but some of this demand is likely to be pushed forward into 2026. Of note recently, several major drilling contractors have stated that brownfield projects account for the bulk of jackup demand and are less susceptible to commodity price fluctuations. However, larger economic or geopolitical issues, continued uncertainty over oil and gas prices could result in some more delays in this demand. Despite the recent contract suspensions and terminations by Saudi Arabia, the Middle East remains the locus of jackup demand worldwide. We're expecting that jackup demand to stabilize from mid-26 through 2027 as Saudi Arabia has begun fixing jackups to long-term contracts once again. This is combined with expected demand in West Africa and Southeast Asia, stable activity in the Far East, and some contract extensions in Mexico in 26 and 27. Saudi Aramco is unlikely to return to its previous demand levels over the next 2 years, which would keep global demand under these recent highs. Looking forward for the global floating rig market, 2026 and 2027 show an improved outlook versus the second half of 2025. We see demand for both drillships and semi-submersibles declining towards the end of 2025 as rigs currently working roll-off contracts. Most rig opportunities currently under discussion are for work beginning in 26 or 2027. We have seen some recent fixtures solidify demand in the next year and beyond, including long-term activity in the US Gulf and South America. Demand for floating rigs could still be vulnerable to declining commodity prices, though contracting has continued despite uncertainty, and many of the projects recently approved have break-even points below current prices. We see long-term drillship contracts for work in West Africa beginning in 2026 and 2027 that we expect to be fixed over the next year. Demand in the US Gulf weakens in the near term, but utilization will likely balance as rigs leave for work in other regions and some short-term spot work begins. Long-term contracts in place in Suriname, Guyana, and Brazil will keep South America as the largest single region for floating rig demand, and we are expecting Brazilian state oil company Petrobras to maintain its demand levels over the next 2 years via current and upcoming tenders. Long-term contracts forecast semi-submersible demand includes benign environment units, largely working in the Far East and South America, and harsh environment units working in the North Sea. Potential upcoming work in the UK North Sea is increasingly focused on P&A activity, with some planned development drilling in question as operators reconsider investment in the region. Looking at this, we do see some potential for day rates to improve after some recent softening. We see near-term improvements for jackups as muted due to oversupply, but premium jackups are likely to see rates improve by 2027. Seventh generation drillship day rates begin to trend upwards on limited supply and improved demand in 2027, though sixth generation rates are expected to remain flatter. Looking at the long-term effects on rig supply, we do expect declining rig count in coming years. While demand is expected to rise over the next 2 to 3 years, rig supply will trend downwards. We have a large number of cold-stacked units in both the jackup and floating rig fleet. Most of these units have been stacked for an extended period of time, over 5 years, and could be difficult and costly to reactivate. We could see some further cold stacking due to excess supply in the near term. At least 10 semi-submersibles are removed from the fleet via conversion or recycling since 2024. And based on current discussions, another 4 drill ships and 2 semi-submersibles could leave the fleet via recycling or conversion in the near term. In addition, few new builds remain. Only 1 7th-gen drillship and 4 semi-submersibles are likely to be delivered over the next few years. And outside of Arrow Drilling's jackups in the Middle East, no significant rig ordering is expected over the next several years due to the high cost of any new generation rigs. We expect increased focus on attrition of less competitive units, along with the upgrading and extending lifespan of core assets by major drilling contractors. We expect offshore drilling to be around for the long haul, but with a reduced total fleet, potentially raising utilization over a longer-term time frame. And some key takeaways from this segment. Offshore rig demand expected to trend downwards over the rest of 2025 as rigs roll off contracts. Most contracts under discussion is for work beginning in 2026 and beyond, leading to an expected upturn in global demand by mid-2026, stabilizing into 2027. After some softening in day rates from 2024 into 2025, rates are expected to undergo some modest improvements over 2027 as demand firms up. And we see near-term uncertainty in the market remaining due to potential macroeconomic and geopolitical issues or commodity price shifts. Demand could shift further into the future as drilling plans are deferred versus outright cancelled. And once again, we see global supply likely to contract in the near term as drilling contractors continue to streamline their fleets and new build orders are limited. I'll now pass the presentation over to Sophia for the Long Last Dance Continues. Thank you, Sophia.
Thank you, Matthew. Hi, everyone. I'm Sophia Frescieri, and I will be walking you through the second part of a webinar called The Long Last Dance Continues, the Case for Long-Term Demand. Next slide, please. Okay, so whenever talking about this topic, I always like to start with an image that shows you 2 different perspectives, 2 different points of view, 2 different worlds. Why? Because that's what we get when we look at IEA and OPEC's oil demand scenarios. Next slide, please. And what we have from those 2 entities is contrasting visions for this future of oil demand. And in this part of the presentation, we're going to look at the key assumptions from both entities and afterwards how those key assumptions have formed the 6 scenarios that we're going to look into detail today. Yes. So we start with IEA. IEA assumes an economic slowdown globally while OPEC assumes an economic growth in the coming years, especially in developing countries. Next, we have IEA assuming a fossil fuel sunset. So there's going to be a scale up of clean power, and that will happen coal decline, oil, and gas. On the other side, OPEC assumes the energy policies, in this case specifically, the switch from internal combustion engine cars to electric vehicles will not be realized in the timelines that we have been given today. Next, IEA assumes renewable energy growth in all fronts. We're talking solar, wind, battery, hydrogen, etc. While OPEC believes that energy security and technology, they will act as demand drivers, as well as population growth, especially in developing countries, will require all sorts of energy, and that will drive demand up. Now, with all those key assumptions, we reach then the scenarios for oil demand. And we will start now with the highest oil demand scenarios. That for IEA is called the STEPS scenario. And that scenario considers that the current path of energy development and government efforts will be enough to meet all the energy goals that we have today. On the other side, OPEC's equitable growth scenario assumes a faster and stronger economic growth for developing countries and renewables falling short on their delivery timelines. Then we have the mid-case scenarios. For IEA, that is the APS scenario, where governments and stakeholders will fulfill all the announced climate and energy access commitments that we have today. On the other hand, OPEC has the reference case scenario, which assumes continued progress in technically and financially viable energy policies will drive demand up. The last scenarios are the ones for the lowest oil demand. For IEA, that is called the net zero emissions by 2050, and it's a scenario that limits global warming to 1.5 degrees. On the other hand, we have OPEC's technology-driven scenario, where carbon capture storage, carbon capture utilization storage, and direct air capture in industrial sectors will allow for continued use of fossil fuels. And also, this scenario is consistent with below 2 degrees global warming. So one question raises after we look at those 6 scenarios. We have targets into the future, but how are we getting to those targets? How are we meeting those targets? How is the oil demand going to behave in the long term? And that is something that we assess in the next slide. And we start by seeing that both IEA and OPEC, they give targets for 2030, as we can see in the chart, and also for 2050. However, a big question remains, which is, how are we going to go from today to 2030 to meet any of the targets that we're seeing on the screen? And how are we going to go from 2030 to 2050 to meet any of the targets that we're seeing on the chart as well? So what we can see is we are presented with the destination, but we're not giving the journey. In trying to answer this question, we have analyzed all 6 scenarios in detail. Next slide, please. We start our analysis looking at the extreme scenarios for both IEA and OPEC. And first thing that we can see in this chart is that we have the numbers. We have the numbers for 2025, this year, and for the previous year. And when we compare the behavior of those curves, so the dashed curves are the curves for numbers from 2023-24, and the solid curves are the updated numbers being used today. When we compare them, we can see that these scenarios, those extreme scenarios, they're reflecting an even stricter oil demand decline, in this case for IEA, or growth, in this case for OPEC. While when we look at the real world progress, we see that it's not responding in the same speed as this oil demand scenario. Starting by looking at OPEC equitable growth and OPEC reference case, which are the upper solid curves on the chart. Those two scenarios, they assume no effort to address global warming, and they also assume a well above 2.4 degree global warming. And when we look specifically at the curves, we can see that the solid curves, which again are the curves for the updated numbers of today, we can see that they're even more ambitious. Oil demand is even higher than it was considered up until last year. Now, when we move to the bottom of the chart to IEA net zero scenario, we know we have almost exhausted the carbon budget to reach the 1.5 degree global warming target. And it is a consensus that we're most likely not going to reach this 1.5 target. And when we look again in the chart, we can see that the solid line shows an even steeper decline, even earlier and steeper decline in oil demand. And for that, Esgian does not use those two scenarios in its forecast analysis. Before we move to the next slide, on the next slide, we're going to talk about the IEA APS scenario. That scenario is represented by the very light gray curve that we see in the middle of the chart. And when we look at the dashed line and the solid line, we see that they're basically overlapping. That means that the updated APS curve hasn't changed much year on year. Next slide, please. Yes, so the updated APS has not changed. However, this scenario relies heavily on the deployment of EV cars. And this replacement of ICE cars for EVs would be in a global scale. However, this 2035 fossil fuel vehicle phase-out target, it is questionable today. Why? Because the EU ban on ICE cars is under pressure. Also, the US support on EV deployment is waning, as we can see in the current climate policies and the recent politics in the country. Developing markets, they're lagging the process in deploying those EVs. And also, we're seeing a recalibration in China, especially given the recent trade tariff issues with the US and with the EU. Also, when we look at the chart and we look at all of the other sectors, which are the four curves at the bottom, we see that they're assuming business as usual in the future, meaning it's a smooth curve from 2030 with a smooth decline all the way to 2050, in contrast with the road transport curve, which has already a very steep decline by 2030. So for that, Esgian also does not use this scenario in its forecast analysis. Next slide. Then we get to here, the Esgian view. Last year, the Esgian view was called the intersection where IEA and OPEC met. However, this middle ground between both entities has shifted. Why this middle ground has shifted? Because the updated IEA step scenario is now projecting a 5% lower oil demand by 2050. And we're going to see the implications of that. But first, those two scenarios. What is one of the main premises that they have? That they consider a gradual phase-in of fossil fuel replacement and new low-carbon technologies. But as I just mentioned, IEA STEPS now has a 5% lower oil demand target by 2050. What is the implication of that? That is implying a steeper decline starting in the early 2030s. And as we have seen repeatedly, this is a pace that the current global process does not yet support. The IEA step scenario is represented, it's being highlighted by the red arrows, and we can see it's the gray curves, both solid and dashed curves. And because of that, Esgian also no longer uses this scenario in its forecast analysis. Next slide, please. So where are we? We are using now the OPEC technology-driven scenario for our forecast analysis because it has remained consistent year on year and because it's still a realistic benchmark for the rig demand forecast that we're doing here. When we look at the chart, the OPEC technology-driven curve is the blue curve that is intertwined with the gray one. And as you can see, the dash curve and the blue curve are basically one. So again, there's a consistency in the updated numbers. Now, what are other premises that this scenario gives us? It gives us the global scale electrification. It will require large amounts of energy. And since that's going to be done in steps progressively, there will be need for fossil fuels in the coming 20 to 30 years. And again, this large-scale replacement of fossil fuel will take place in the long term, not in 5 years, but in 10, 15 to 20 years. For that, Esgian uses this scenario in its forecast analysis. Next slide, please. So where are we today? Esgian's forecast holds true a year later. Long-term offshore drilling demand remains resilient. Next slide, please. And we start talking about this long-term offshore drilling demand with rig supply, long-term rig supply forecast. For the purpose of this exercise, for 2025, we have a total rig supply of 698 rigs, and we consider 155 of those rigs uncompetitive. Out of those, we also have 25 rigs under construction. We're also assuming that additionally to the deliveries that we have already seen this year, we will potentially see 3 more and possibly 8 more rigs being scrapped. And that leaves us today in 2025 with a competitive rig supply of 513 rigs. And what are the assumptions to create this long-term supply? Again, we're considering uncompetitive rigs. And for us, those are long-term cold stack rigs, stranded assets in shipyards, operator-owned rigs, sanctioned rigs. Again, we don't expect new build orders, new build orders going on, as Matthew has also pointed out in his presentation. As mentioned, the potential deliveries that are to happen for floaters and jackups, they will happen by 2030. Attrition would slow down after 2030 to meet this of the long-term rig demand. And we would possibly be seeing cold stack rigs being reactivated rather than scrapped. And also we would be seeing more upgrades and life cycle extensions in those rigs rather than having them being scrapped. Next slide, please. And with that, we get to our offshore rig long-term demand. This is what we call the golden sunset. And here what we have is that the golden sunset continues. So offshore drilling remains vital in the energy transition. The offshore drilling demand curve is in the chart at the top. And we have a few assumptions that have led us to this exercise. So first of all, when it comes to global oil demand, we're assuming 30% offshore production. We're also assuming a 6% depletion and the need for new barrels to offset said depletion. We're also assuming an average 6-year time lag from drilling to first oil and drilling efficiency. With that, we see that rig demand is expected to remain healthy for the next 15 to 20 years, as we can see in the chart, in the first chart to your right. Now, in this chart, we're still plotting the offshore rig demand from the IEA steps scenario, just to highlight and just to illustrate actually this steeper decline that I mentioned already from the early 2030s. By introducing this new 5% reduction in the 2050 oil demand target, the need for rigs would have a drastic drop already next year. And again, this is unrealistic to global energy security needs and the progress of renewable deployment. With that, we remain using OPEC technology driven, and that is the blue curve that we can see in the chart. Now, with that competitive rig supply from the previous slide and this offshore rig demand, we then have utilization. And that is the chart at the bottom. And as we can see, utilization could be as high as 90%. And what is utilization for us? That is rig demand over competitive rig supply. Now, high utilization will keep day rates high through the decade and possibly longer. Next slide, please. And with that, I have some key takeaways before we end today's session. So this view that I have just presented is based on a realistic perspective for development and timing of new green alternatives. Offshore drilling, as we just saw, could remain vital for the next 15 to 20 years, and that is, again, driven by energy security, population growth, and gradual electrification. With limited new builds and gradual attrition, competitive rig supply is expected to decline slightly, and that will support high utilization and day rates. Also, offshore rig utilization could approach the 90%, indicating a tight and profitable market for contractors through the decade. And the most important part, no sunset yet. Offshore drilling remains critical to meet global energy needs while low carbon technologies scale up. Thank you very much. I pass the word over to you, Afrona and Matthew. Thank you.
Thank you, Matthew. Thank you, Sophia, for this detailed market analysis. It looks like the presentation was well received today. However, please don't hesitate to reach us out if you wish to discuss any parts of the material presented today. Thank you again to all of you for participating. Have a great day ahead and see you all after the summer at our next webinar.
Thank
you
you
all.
very much.
Thank you.
Thank you, everybody.